Hi everyone, welcome back to UPSC Warriors channel by Unacademy. This is Soundharya. So now we are going to discuss the potential implications of the United States Federal Reserve's policy decisions, that is to reduce the interest rates by 1% on the Indian economy as well as the economy of the United States. So what if I tell you that this 1% decline in the rate cut from 5.5% to 4.25 to 4.5% is going to have a series of chain reactions across all the elements in the economy, starting from the debt market to the investor sentiment in the equity market, and to the strengthening of dollars, weakening of Indian rupees, widening of trade deficit, and the potential implications and challenges that we are going to witness on account of outflows of foreign investments, and how this is again going to trigger our trade deficit, weakening of Indian rupees, and how the RBI is going to deal with this in its next monetary policy meeting. So we are going to study the interrelationship between all these things with respect to this particular decline in the rate cuts made by the United States Federal Reserve. So this is going to be very, very important as well as interesting. So stay with me for the next 5 minutes where we will discuss everything. But let's begin with a question now. Why did the United States Federal Reserve go for rate cut after maintaining it for a constant period of time? It is because the United States wanted to leverage the economic prosperity and the growth scenario that is existing right now in United States. Why? Whenever we go for reducing the interest rates, it is again going to decrease our cost of borrowings, yes or no? So this will allow us to borrow for lower interest rates from the banks, right? So this is going to increase the borrowings. So when borrowings are going to get increased, this will increase the cash flow or the money supply in the economy. When the cash flow or the money supply is getting increased, this will lead to increase in demand. Okay, so when there is increase in demand, this is going to lead to increase in production, and this is something going to make the investors rethink their investment decisions. So when the production is getting increased, we can have increase in job creations also. So this is again going to be very, very significant for the economy. So in order to have the economic growth, in order to have job creation, the United States Federal Reserve wants to go for decreasing the rate cuts. In fact, the Federal Reserve earlier stated that it is going to make 4 such rate cuts in the year 2025. But right after the election results, we know that Trump is going to be the next president of US, and his administrative policies, especially around the tax cuts, and the higher import tariffs that he is going to come up with, is likely to increase inflation in the country. Why? It is going to increase the price of goods and services. When the imports cost are higher, the price will increase. So this is again going to lead to inflation. So citing this particular possibility as the reason, now the Federal Reserve stated that it has changed its decision. It is going to do only two such rate cuts in the coming year. Why? So whenever this thing is happening, this can again, lead to inflation also. When there is higher demand, it means what? The price of the products can increase with constant supply, leading to inflation. So the current inflation of the United States is at 2.7%. Citing this particular possibility as the reason, now the Federal Reserve stated that it is going to have 2 such rate cuts only in the coming year. So far the story is clear. Now we have to move to the impacts of this particular rate cut on the United States economy as well as the Indian economy. There is a quick announcement that I'm going to make here. Now the UPSC CSE subscription for your Unacademy platform is available at 50% offer rate, and if you are someone willing to qualify UPSC CSE next year, this is the right time for you to enroll, because if you take 9 months subscription plan, you will again get 9 months extended for free after your subscription ends. Same thing goes with your 12 months and 18 months also. Now let's get into the impact on the United States first. Let's start with higher bond yields. So when we discussed about, raising money through debt and equity in one of the videos we, had earlier, I was saying you that in order to raise money from debt market, you need collateral, right? And you can go for debt market for raising money when the interest rates are lower. So how this debt market is functioning? Debt market functions with the help of bonds, right? So you have to issue bonds to what? Get money. So the bonds will actually, act as a kind of collateral. So whenever the interest rates are lower, people will move towards debt market than towards equity market, so as to not have the condition of diluting your shares. So this is again going to increase the demand for the bonds, and hence the bond value or the bond yield will also increase. So this is something which is actually favorable for the debt market, and this is something which will make the investors to shift their investments from equity to the debt market. And this is the reason for witnessing decline in stock prices in the United States. And this particular company, Dow Jones, witnessed a significant decline of more than 1% alone in just one day, right after this federal rate cut came out, right? And then, so this is something which is associated with decrease or decline in the stocks, because people prefer debt investments over equity investments. So I hope this part is clear now. And one of the other, impact that it could lead to is again leading to higher inflation because of increased borrowings and increased economic activity, money supply, and we already discussed increase in the demand for the products, right? So this is going to be the impact on the US. Bond yield is going to get increased. Second thing, this is going to affect the stocks of the United States, which we already started to witness right from this particular company, Dow Jones, etc. And this is again something which can lead to inflation in the long run, this reduction in the rate cuts. Now let's move on to the impact on the Indian economy. This is something which is very important for you to understand. We already started to witness decline in the stocks performances in just one day by more than 1 percentage point. So the Nifty and the Sensex witnessed a decline by 1,000 and 332 points respectively in just one day alone, right after this rate cut came into picture. So why it is happening? It is happening mainly because of the outflows of foreign institutional investments, because of the strengthening of the dollars, right? So when I want to invest in any country like India, if I am able to get good amount of money when I take back my returns to my home country, then I will choose India. But what is going to happen here is that this is something that is going to get affected because of strengthening of dollars. See, now the investors will rethink. They will find that investment, investing in US is going to be very attractive than investing in India, because the bond yields are going to be higher. So why will I go and invest in the equity market in India? Rather, take my money out and go and invest in the bond market or the debt market of the United States. So this is something which will lead to outflow of foreign capital. So when the dollar is moving out of the country, this is going to decrease the dollar supply. Clear? So when the dollar supply is getting decreased, this will increase the value of the dollar. So when the value of the dollar is getting increased, what will happen to the value of Indian rupee? Value of Indian rupee with respect to dollar will decrease. When the value of Indian rupee with respect to dollar is decreasing, whatever the returns that I am getting in a country like India, if I take back to my country after converting that money into dollars, I will have less amount comparatively. So this will again not be favorable for me to, continue investing in India. So let's try to understand this with this example. The value of Indian rupee decreased to a record low of almost 85 rupees per dollar. So if I am making investments in India and getting returns out of it, for every dollar that I earned, I will have, 85 rupees spent there. So this is something not good, right? So the value of dollar is getting increased when compared with the Indian rupee, and the investments are quite attractive in the United States. This is something which is going to trigger the outflow of foreign institutional investments and the capital flows. And then how it is going to affect the other parameters when we already have the issues of higher trade deficits, that is about $38 billion in last 2 months alone. This is something which can again impact the economy. Why? Because this means that our imports are higher. So higher imports means what? The value of, again, dollar is going to be greater than the value of Indian currency like rupee, right? So this is something which is known to decrease the value of Indian rupee. So when the value of Indian rupee is again going to get depreciated, this can again strengthen the value of dollars, again leading to outflow of investments. So this trade deficit is very high, especially, to give some example, the import of gold stood so high, that is about $15 billion worth of gold was imported in the last 1 month alone. So these are some of the combined effects that you have to consider while studying the impact of this particular rate cut, right? So we already witnessed the Sensex to plunge by 1,000 points, and this particular, strengthening of dollar is again going to create headwinds for the commodities, particularly the precious metals. So these are some of the possible impacts that you can expect for a country like India. To sum up, outflow of foreign investments mainly because of better attractive investment opportunities in the United States, especially in the United States bond market and the debt market, right? So this is something going to again strengthen the dollar's value and weaken the value of Indian rupees. So this is again going to pave way for trade deficit. Already we had trade deficit, so this is going to be a cycle, right? So what is very important for us is to know how the coming months are going to be for a country like India. Of course, it is going to be very challenging, and especially for the RBI, to go for its next MPC meeting, it should decide what type of policy initiatives it should take, because decreasing interest rates in US is again going to make it challenging for them. So has to balance it, either, to go for interest rates, or either it should go for maintaining the policy neutral, or what are the things that will work out for India. Right now, we are also witnessing, slowdown, high trade deficits, etc. So already we witnessed a significant amount of outflow of FII in the last month alone. So this is going to be very, very challenging for us to watch out. So just keep a track on the policy, measures that we are going to have in the coming months to understand the implications much better. So before we wind up, there is a quick announcement that I'm going to make here. Now the UPSC CSE subscription for your Unacademy, platform is available at 50% offer rate. And if you are someone willing to qualify UPSC CSE next year, this is the right time for you to enroll, because if you take 9 months subscription plan, you will again get 9 months extended for free after your subscription ends. Same thing goes with your 12 months and 18 months also. In addition to this, we have some of these classes getting started, and we also have a free UPSC mock interview program that is going to be conducted by the Unacademy entirely for the free of cost. So that's it for today from my side. Thank you so much for watching.